Welcome back. I'm coming to you live this morning from the Milken Global Conference here in Los Angeles. Markets have been on a record run, of course, in recent years. But could Wall Street be on a collision course with disaster? That's what my next guest says. Joining me right now is Guggenheim Partners Chief Investment Officer Scott Minerd. Scott, good to see you.
It's always great, Maria.
That's pretty dramatic of you. It says you think we're on a bumpy road toward a recession.
Well, I think, I was going to say, I have to make it sound exciting, right? That's what nobody's going to read it.
Okay.
But I think we are. I mean, look, given where fiscal policy is and the highly stimulative nature of the tax cuts, it's going to give a really strong lift to the economy over the next 12 to 24 months. Well, at the same time, we're past full employment. We're starting to see wages rising. We're starting to see core CPE get above 2%, which is the Fed's target number. And so the Fed is going to just continue increasing rates to fulfill its mandate. And eventually, once, 2 years from now, the stimulus is wearing off and the growth numbers are starting to flatten out, we're going to find ourselves with restrictive monetary policy, and inevitably that is the collision.
Now, that is exactly what I asked Steven Mnuchin last night, the Treasury Secretary. I said to him, and I talked about the Dallas Fed president, Robert Kaplan, who said to me, by the end of 2019, by the end of the year, he thinks we're going to see growth of 1.75%. That it's going to go all the way back down from close to 3% this year. And he said, no way. He said there's a lot of runway for the tax cut plan, and we're going to continue to see that impact the economy.
Right. Well, and look, the whole theory there is that after we get past the initial stimulus of the tax cut and the lift that it's supposedly going to give to consumption, and as we were talking, that hasn't been proven yet. But the reality is that the longer-term impact of the tax cut, which will enhance productivity through the capital investment and from expensing and lower tax rates for corporations, takes a long time to build up in the system. Traditionally, that sort of impact hasn't hit the economy until 5 years after the tax change. So I think the Secretary Mnuchin is probably correct in that they've raised potential output for the economy, but they've raised potential over the long haul. And in the short run, I think, President Kaplan is probably closer to reality, which is we will see a slowdown inevitably around 2020.
And in 2020, you think it's the beginning of a recession?
Well, I think so, because at the same time, the Federal Reserve is going to be really focused on its mandate, which is, right, remember, they're here to reach full employment and to assure price stability. Well, they've already fulfilled the full employment mandate. And with prices taking off and wages taking off, they're going to feel a lot of pressure to keep raising rates for the next 2 years.
All right, so this year, how are you investing this year, given the fact that you're pretty positive on the backdrop this year?
Right.
How do you allocate capital?
Well, look, the data shows us that in history, the 2 years before a recession is exceptionally good for stocks. I think we're going to get a recession in 2020. So this year should be very good for stocks, especially emerging markets. I think that they're going to benefit from all the capital spending that's going on in the United States. And so that's a great place to be. As far as bonds are concerned, we're staying away from credit risk. When you look at junk bonds, corporate bonds, credit spreads are at their historical tights relative to U.S. Treasury securities. And so if you're going to have a fixed income investment, it should be a pretty high quality allocation.
Right. You also say, Scott, that rational immigration and deportation policies are what's needed for the U.S. to succeed in the 21st century. What do you mean by that? Of course, the president has been pushing for legislation to crack down on illegal immigration into the U.S.
Right. Well, there are two things here, right? And one thing I want to be clear about, I do not favor just throwing the doors open and allowing everybody to come into the country. But when you look at an economy like Australia, which is in its 26th year of expansion, you say, how did an economy avoid recession? And that was because Australia built a policy that allowed labor to grow at a rate that was fast enough to keep from having overheating in wages and prices. And so they have developed a very rational immigration policy where they allow people to come into the country that have the skills that they need to continue to build the economy. If you look at the United States, right now, Maria, we're running out of labor. In the housing sector, there's a chronic shortage among framers, drywallers, painters. And so we're starting to see a lot of price or wage pressure in that sector. These sort of skilled workers we need a lot of to keep the expansion going. And one thing I keep reminding people is, when you look a generation out and you see where America is relative to China, at 2040, 2050, the Chinese economy will be roughly 3 times the size of the United States.
Yep.
That means if they spend 3% on defense, we'll have to spend 9% on defense just to have parity with them.
Wow.
The only way out of this is to grow our factors of production, and labor is probably the place where we're most chronically short.
I think you make a lot of important points, and this labor issue is something that a lot of people are bringing up. I think more and more people are understanding the issues around this lack of workers and what it will mean for the broader economy. Scott, it's great to get your insights. Thank you.
Thank you, Maria.
Good to see you. Scott Minerd there.